Since central banks have a monopoly on the issuance of currency, I think it's important for us to talk a little bit about their responsibility to ensure that the currency that they issue or the currency that they've chosen to use for interbank settlements retains value over time. And that means that ideally it should either be or be backed by some kind of reliable asset or portfolio of assets. So in this next section, we're going to talk about three of the commonly used assets that are used to support currency. We'll talk about gold, land, and government debt. Though strictly speaking, any kind of currency could be used, or for this purpose, or any kind of asset rather, could be used for this purpose of underlaying an issued currency. So the first one I want to talk about is gold, because there is a very broad misunderstanding among people that if we just used gold as our monetary base, we wouldn't have any problems with inflation. But this is most definitely not the truth. Historical record breaks this apart. Most people are making this assumption on the basis that inflation was fairly contained during the period of time in the 1800s when the Bank of England uh, used a gold standard to underpin the value of the pound. But if we go back even further in time, we see that economies are deeply affected by the quantity of gold that is available, not simply by the notion that gold is worth something on its own. So my first example of this involves Malian Emperor Musa I. Musa, being a devout Muslim, but also the heir to a particularly wealthy West African empire, decided to travel to Mecca in 1324 to complete the Hajj. Now, in addition to having to complete this kind of pilgrimage, those of you who are familiar with Islam might know that there is a required sort of donations to the poor or zakat that is expected of people, that we are supposed to, or people who are particularly devout, are expected to provide material wealth to the poor, not simply notes of credit, but something that is of real value. And so Musa's take on this was to distribute the massive, massive amounts of gold that he brought with him as he traveled from Mali to Arabia. Now, how much gold are we talking about? Roughly 7,000 kilograms of gold. He had an army of people following with him. It's estimated that his retinue is as many as 60,000 people. So literally, Emperor Mansa Musa travels with a small town or a small city with him, as well as with thousands and thousands of kilograms of gold in pure and open display. Now, as he travels through Egypt, he gives away an extraordinary amount of gold to the poor. It's estimated that historically he may have multiplied the quantity of gold in the local Egyptian economy by a factor of 10, which immediately resulted in massive inflation. Because what happened is, as he passed through, he not only gave money to the poor, but he also paid for everything that his 60,000 people needed with gold. So what Egypt ended up with was fewer goods and a massive amount of yellow rocks. So unsurprisingly, the value of everything else as measured in yellow rocks rose dramatically. The price of everything in terms of gold rose, or seen another way, when gold became more plentiful, its value relative to everything else declined. Now, on his way back through Egypt, Musa realizes that he's created all of these sorts of problems and then decides to buy back all of the gold that he possibly can and to try to bring this gold out, pull this gold out of the Egyptian economy. Uh, the money lenders are willing to do this for him, but when they try to charge him interest on the loan that they've made of gold to him, he immediately pays them back in full, basically decrying them for violating Islamic law regarding the charging of interest, but basically also takes the position of fine. You want to be difficult with me? Take a bunch of the gold I gave to these people, and you figure out the problem. And as a result, the Egyptian economy is severely disrupted over the next 10 years as it tries to find a new price level to accommodate all of the excess gold that has built up in their local economy. Another example of too much gold, or too much silver, even for that matter, occurs once the Spanish Empire is able to conquer the Aztecs and the Inca. They immediately get down to looting massive amounts of gold and silver, thousands of tons of it, mostly through plunder, but also through exploiting mines like the Cerro de Potosi, and sending all of this wealth in vast treasure ships back to Europe. Now, as a result of this, we see what's called the price revolution that begins to take place in the 1500s as a result of this massive amount of extra specie entering European economies. prices start to rise. Now, historically, the rate at which prices were rising was about 1.5% a year, which sounds hilarious by modern standards, but this was a huge deal. Prices prior to that, in terms of gold or silver, had been relatively stable, and to suddenly see an increase over a span of, say, 40 years of 50 or 60% in terms of prices was dramatic for the people who were living at that time. It's also worth noting, though, that even though they brought in tons of gold and tons of silver, the Spanish weren't made that much richer off. They saw a temporary boost, but as the merchants who would sell things to the Spanish Empire began to realize an excess amount of gold or silver is hard to metabolize. It's hard for them to necessarily siphon all of that off to other foreign markets. And so temporarily, European markets were over full of gold and silver, meaning that the value of gold and silver relative to real goods was in fact depressed. And interestingly enough, the Spanish did not enter economy. They instead focused almost entirely on plunder and slave mining in order to sustain their high-end consumption. As a result, in the first 105 years of the Spanish Empire in the New World, their empire defaulted on their debts 9 times. So you can see quite clearly that having a lot of gold or silver does not necessarily mean that you have become wealthier, because your people can't live in gold. They can't eat gold. They can't drink gold. All we can do is convert this asset into the things that we actually need. And if we flood the market with gold, we'll find that it doesn't tend to retain much value. Now, another example of a currency that can be used to, or an asset that can be used to underlie a currency is land. Back in the 18th century, the United States colonists ran into some serious difficulties with not having enough metal to make payments. This is largely because the people who had moved there were farmers and were people who were trapping or hunting the land and working it, as opposed to necessarily mining it. Mining and processing of raw metals tends to require a fair bit of investment and capital, and this was simply not available. Not to mention, the lands that had been chosen for settlement were not chosen for their mining potential, they were chosen for their agricultural potential. And so America had a lot of land, but not a lot of metal. And so, unsurprisingly, they started to use land as the fundamental asset that would guarantee paper currencies. Now, of course, there are some problems with this, especially for an outsider. While people who live in a particular, say, valley who are aware of the quality of their land might be comfortable accepting land as an underlying asset for currency, those who cannot view that land or those who have never been there face a serious asymmetric information problem in that they can't be certain what the quality of the land is, whereas they can fairly easily verify, say, a quantity of silver. As opposed to trying to estimate whether an acre of land is a swamp or is productive farmland. Now, to some extent, we still see the use of land banking in America. It's worth noting that mortgages represent a very significant asset on the balance sheets of the Central Bank of the United States. Before the 2008 financial crisis, the Federal Reserve was largely financed with 90% government debt and then about 10% other mixed assets. As we move through the crisis, by December 2010, we find that the amount of government debt has fallen to just 25% of assets, and that 2/3 of their balance sheet is constituted with mortgages. By April 2019, just prior to COVID disasters, we find that they've managed to change the composition of their balance sheet yet again. It's roughly 50% government debt, only about 40% mortgages, and 10% other. We'll talk a little bit more about quantitative easing a little bit later in this set of lessons, but it's worth noting that there have been substantial changes in the composition of the Federal Reserve's balance sheet over the last 12 years as a result of cascading financial crises. Now, the other major asset that was used to underlie currency is government debt. In fact, the Bank of England, founded in 1694, was designed specifically to help rationalize England's national debt by buying up large quantities of it and then repackaging it for investors, effectively paying them a dividend on their Bank of England stock based off of the interest they received on government debts. Paper currency that had thus effectively represents government obligations that we can use to net out against tax obligations. When we used government debt as our foundational asset, we find that it's actually quite flexible although it does suffer from problems of governments that print up too much debt. If central banks aren't cautious about how much government debt they buy, they may find themselves in a position of issuing good money backed by bad promises. So there are situations where governments have simply focused a little bit more on printing too much money in the short term to manage any sort of liquidity crisis they might have. Typically, this happens during wars or other kinds of major disruptions. We're seeing a little bit of this now with COVID-19, where governments are massively expanding money supplies. But we haven't seen the kind of expansion of money supplies that we see in the late 18th century. For example, between 1775 and 83, during the American Revolutionary War, the new US federal government issued so much debt that by the time the war was done, they owed 400 times their annual tax receipts. Just a few years later, the French Revolution takes place. And between 1790 and 1795, the French revolutionary government multiplies the amount of currency in circulation by 45 times over. Unsurprisingly, the value of money cratered and prices collapsed until finally, French people rioted and destroyed the printing presses that the revolutionary government was using to print up all of this currency. And this leads us to the next major issue, which is hyperinflation. The possibility that a government simply prints up too much money, not necessarily by accident, but entirely by design. And this is a major problem. When we see prices increasing at rates of over, more than 10 times multiplied in a year, or over 1,000% increase in prices, these are almost universally the result of political choices made by the issuer of currencies. So let me give a couple of examples of politics that lead to the destruction of currencies almost on purpose. In 1923, France and Belgium were frustrated by Germany's, you might say, foot dragging over their remittance payments from the Treaty of Versailles in response to World War I. So in 1923, France and Belgium invade Germany. We're often, focused on this idea of the Germans invading the French, but in 23, it was French tanks that rolled across the Ruhr and seized the industrial heartland of Germany. The government at the time of Weimar Germany called for a general strike and decided to pay all of the workers in the Ruhr Valley to simply passively resist. Don't go to work for the French, stay home, we will send you free money. Now, the problem was that as they printed up lots and lots of paper, and as the industrial output of the country collapsed, the value of this papier mark, or this sort of government promise of paper, fell to nothing. And you'll often hear stories about people taking wheelbarrows full of currency to try to buy loaves of bread, or people burning old currency because it was cheaper than firewood. Another example about a government sabotaging their own currency occurred in Zimbabwe at the beginning of the 21st century. Between 2000 and 2008, Zimbabwean officials printed up literal mountains of paper currency in order to finance their wars in the Democratic Republic of Congo, and of course to pad their own pockets and live remarkably well. Ultimately, though, it should be no surprise that a government simply printing up money to enrich itself and to wage foreign wars would ultimately crater the value of their currency. They're not creating real value in society. We're not building more houses, building more roads, educating our people. We're just printing up a bunch of numbers on paper. And you can see what the result of that is in the top right-hand corner here. This is a $100 trillion bill issued by the Reserve Bank of Zimbabwe. That's not a joke. This was the highest denomination of currency that was ever printed. I, in fact, have a $50 billion bill myself, issued by the Zimbabwean government back in 2006, when they were still issuing billion-dollar bills as opposed to trillion-dollar bills. It's worth noting at the height of this hyperinflation that prices were doubling roughly every 24 hours across the country. And this was not because there was some kind of economic disaster. They created an economic disaster by overprinting paper currency and ultimately destroying the ability of people within their country to transact predictably with one another. Similar sort of thing happened in Venezuela. Venezuela effectively destroyed its own economy through a complex series of very terrible decisions taken by first Hugo Chavez and then Nicolas Maduro. As a result, we've seen that there have been compounding economic problems, which the Venezuelan government has simply been unwilling or unable to control. As a simple example, when we take a look at the rate at which prices are increasing in Venezuela, even now, we're looking at several thousand% per year since 2016. So in the last 5 years, the compound rate of inflation has been 1.5 billion%. making Venezuelan currency today effectively worthless. The shelves are empty. Over 80% of the population is in dire situation. And all of this is the result of political choices that were made by the government of the day. There were a lot of opportunities for Venezuela, who used to be one of the richest countries in the Western Hemisphere, to prosper off of its oil wealth. But instead, a series of poor government choices systematically led to the destruction of their currency and thus their economy. So, what can we do in the case of hyperinflation? Most economics classes will tell you the story of German hyperinflation, but they often fail to explain how it is that countries escape from hyperinflation. And it turns out it's really easy. The idea is that we have to move away from currencies that are simply backed based off of a government's promise. And in these situations, we realize that government promises really aren't worth the paper that they're printed on in many cases. So instead, if we want to control the rate of inflation or we want to stabilize prices within our economy, what we need to do is to circulate a new kind of currency that's backed by a real, verifiable, observable asset, preferably, which can generate yield that is relatively easy for people to value. So I'll give you two examples of escaping hyperinflation. The early Soviet hyperinflation, which saw 10 trillion% inflation compounded over a period of 6 years, was finally ended in 1924 by the introduction of what was called the gold ruble, which was unsurprisingly backed by gold. The Soviet government during the period of the Soviet Civil War had printed up massive amounts of currency, partly done to finance their expenses, but also done to intentionally ruin the upper classes who relied on the value of government promises to pay. And of course, this was very successful, but it ultimately destroyed their economy, which led to dramatic amounts of poverty and starvation in the Soviet Union throughout the 1920s, on top of what the government was already imposing on their people. Nonetheless, the gold ruble did stop Soviet hyperinflation, and that enabled them to begin to form a modern industrial economy in the 1920s. Start. It took them decades to achieve that, but without having the stability in their currency system, there was simply no possibility of the Soviet Union ever getting its act together. Similarly, in Germany, the same year, 1924, the hyperinflation caused by the French invasion of the Ruhr and the government's overprinting of currency was stopped very easily. A new currency called the Rentenmark was issued. It was a small transferable bond that was denominated in relatively low amounts of currency so that it could be used for everyday payments. But it produced interest, and the interest that it paid off was backed by rent that was paid on housing, as well as the real output of factories. And this meant, of course, that there was now a real verifiable reference asset that people could look at. There was a limit on the amount of currency because the currency had to be backed by physical goods. And in just 6 weeks, even though this was not technically a legal tender and could not be used to legally settle obligations, especially loans or debts to the government, the public used the Rentenmark as currency, and it took just 6 weeks for prices to stabilize in 1924 Germany. In Zimbabwe, rather than going through the difficult effort of creating any kind of currency backed by a hard asset, they simply elected to use US dollars starting in 2009. Today, however, it's illegal to use US dollars in Zimbabwe as they are attempting to provide more support to their newly issued Zim dollars. We'll see whether or not they'll be able to retain the value of this currency a little bit better now that their strongman Robert Mugabe has shuffled along. It's a real open question as to whether or not the politics of the country have changed, because as we saw in the case of Venezuela, simply changing the leader does not necessarily change the policies, which can undermine the value of currency.